The Airbnb market in 2025, hold or exit. Between 2024 and 2025, the U.S. housing market has entered a modest but impactful correction following the unsustainable price surges of 2020 to 2022. High interest rates, persistent inflation, and economic uncertainty have slashed buyer affordability by 20 to 30% across many regions. Investor-heavy markets such as Phoenix, Austin, and Boise have already experienced price declines between 5 to 15%, while inventory remains tight and demand continues to cool. New Jersey, while somewhat more resilient due to limited housing stock, strong commuter demand into New York City, and reputable school districts, is not immune to these national pressures. Softening is clearly visible in urban markets like Jersey City, Newark, and Hoboken areas that saw a flood of investor interest during the pandemic. Regulatory tightening, rising insurance costs, and a flood of short-term rental inventory have begun to suppress both home values and rental returns. The state's coastal towns, once the backbone of seasonal Airbnb success, are also showing signs of strain. While destinations like Asbury Park, Cape May, and Ocean Grove continue to draw demand, more traditional hotspots such as Seaside Heights, Wildwood, Atlantic City, Long Branch, and Point Pleasant are now struggling. These towns, which benefited from a post-2020 Airbnb surge, are seeing declines in occupancy rates, shorter average stays, and shrinking nightly revenues due to oversupply, increased competition, shifting traveler behavior, and stricter municipal regulations. Nationally, Airbnb demand is stabilizing, but travelers are opting for more affordable, mid-tier options. Oversaturation in top-tier cities has compressed average daily rates and occupancy, while municipalities such as New York, San Diego, Boston, and Los Angeles continue to impose strict regulatory frameworks. In New Jersey, enforcement is ramping up fast. Several towns now require STR licensing, primary residence verification, and tax compliance, all of which increase friction for hosts. As a result, both nationally and within New Jersey, the Airbnb market is entering a new phase, where profitability is no longer guaranteed, and operational strategy is more important than ever. Urban hosts face rising costs and shrinking margins. Shore towns must now compete in a more crowded and regulated landscape. Whether you own an Airbnb in Newark or a beachfront duplex in Wildwood, the next 6 to 9 months could determine whether your property remains an asset or becomes a liability. How rising operating costs could turn Airbnb into a money-losing asset. Many investors are discovering that their Airbnb properties are now operating at or near a loss, even during the high-demand summer season. The factors below illustrate why, over the next 6 to 9 months, many STRs may cost more to operate than they earn. Property taxes. New Jersey has some of the highest property taxes in the country. Many municipalities reassessed properties in 2023, 2024 based on inflated pandemic-era values. Tax bills have risen even while home values soften. Insurance costs. Flood insurance premiums are surging along the coast due to FEMA's updated Risk Rating 2.0 system. Shore towns are being reclassified, and private insurers are pulling out of high-risk zip codes or increasing rates by 20 to 50%. STR licensing and compliance fees. Cities like Newark, Jersey City, and Hoboken now require annual licensing, inspections, insurance verification, and hotel-motel tax registration. These costs can exceed $1,000 per year per property, before even factoring in retrofitting costs, for example, smoke detectors, fire exits, off-street parking. Management and cleaning costs. If owners aren't self-managing, STR platforms typically take a 3 to 15% cut, and property managers often charge 20% or more. Cleaning costs are rising due to labor shortages and compliance with hospitality standards. Multiple turnovers per month mean higher cleaning bills and guest service expenses. Occupancy rate compression. In many NJ cities and suburban STR zones, occupancy is no longer what it was in 2021-2022. Increased competition and guest pickiness are leading to lower booking rates, shorter stays, and fewer last-minute reservations. A drop from 75% to 50% occupancy can devastate cash flow, even with the same nightly rate. Maintenance and capital expenses. STRs have higher wear and tear than long-term rentals. Furniture replacements, linen turnover, appliance repairs, and guest-related damages, often uncovered by platform insurance, are frequent and costly. Financing and refinancing challenges. Owners who purchased with adjustable-rate mortgages or investor loans may now be facing interest rates of 8 to 10%. cash-out refinancing options have largely dried up, and lower DSCR performance may block refinancing altogether. Marketing and automation costs. Airbnb hosts are now expected to offer hotel-level hospitality, instant messaging, automated check-ins, personalized guides, and digital concierge features. Those who do not invest in tech and branding will fall behind, which creates a costly arms race. In short, even well-run Airbnbs are seeing reduced net income. For smaller, self-managed hosts or those operating in cities with rising compliance burdens, the property may actually lose money every month, even in peak season. Pros and cons: staying in the Airbnb market over the next 6-9 months. Pros of staying: seasonal income in Q3 2025 may help offset short-term losses. Potential interest rate cuts could revive buyer activity by early 2026. Time to reposition the asset: furnishings, midterm pivot, repairs. Avoid competing with distressed sellers exiting in summer 2025. Cons of staying: daily operating costs continue to rise while occupancy declines. New Jersey municipalities are actively introducing tighter STR regulations. Profit margins are shrinking and in some cases, turning negative. Delaying exit could lead to lower valuations if the market continues correcting. Exit strategies to maximize value. Turnkey sale to investors. Package the property as a fully furnished, income-producing STR. Include operating data, air DNA projections, and management agreements. Sell through investor platforms or real estate investor networks. 1031. Exchange. Sell and reinvest proceeds into more profitable or stable assets. Multifamily, Midwest long-term rentals, out-of-state short-term markets with light regulation, or even commercial real estate. This defers capital gains and allows portfolio diversification. Midterm rental repositioning. Convert to a 30-90-day furnished lease model, targeting corporate stays, travel nurses, or academic guests. This eliminates regulatory risk and reduces vacancy while keeping the property cash flowing. Retail sale as primary residence. List the property as a home for sale to primary buyers or second home owners. Debrand it from Airbnb and market it as a family residence or vacation home. This often yields a higher valuation than investor-focused sales. Strategic recommendation: if your Airbnb property is operating at break-even or loss, particularly in regulated NJ markets, the risk of further losses in Q4 2025 and Q1 2026 is high. A summer 2025 sale may be the most profitable exit point. If you're in a high-performing seasonal market and you have cash reserves to withstand volatility, consider operating through the summer, then transitioning to a midterm model or listing for sale in Q4 before winter hits. If your asset is equity-rich, you may wish to reposition it and refinance later under more favorable DSCR or interest rate conditions, but this assumes local regulations won't deteriorate further. Final thought: the investor's equation. The decision to hold or exit an Airbnb property must now include a hard look at net cash flow, regulatory exposure, insurance and tax inflation, and future cap rate compression. Staying in the market for another 6 to 9 months might offer one last strong season of income, but it also carries increasing risk that the property will cost you more than it earns, especially in New Jersey's urban or coastal regulatory environments. Exiting now may lock in equity, allow for reinvestment into more stable vehicles, and help you avoid the wave of distressed STR listings that could hit the market later this year, or in early 2026. If you'd like, I can provide a custom property analysis worksheet comparing your current Airbnb revenue versus projected operating costs under different scenarios, or help write an investor sales pitch to position your property for a turnkey exit.